Chapter 2, Foreign Exchange or Forex. Our today's lesson is in the second part, but we already have studied the part 1. In this part, we already have studied 4 lessons. If you are new and have missed these lessons, so I have mentioned their links in the comment below. So don't forget to watch these lessons. Part 2. Lesson 5. Online trading and brokerage important terms. Lesson 6. How brokerage and online trading works. So today we are going to teach you these 2 lessons. Let's start. But prior to start our today's lesson, don't forget to subscribe to our channel now to watch our courses for free. Chapter 2, Lesson 5 and 6. Content. Online trading and brokerage important instruments. Second, how brokerage and online trading works. So for understanding how brokerage and online trading works, you have to understand the important brokerage instruments. That helps you for better understanding how brokerage and online trading works. Online trading and brokerage important instruments. 1. International currency markets. International currency markets refer to the global network of exchange brokers and dealers that trade in the world's major currencies. It is a 24-hour over-the-counter market where the banks, corporations, governments, and investors buy and sell currencies. The international currency markets are the largest and most liquid in the world, and they are used to facilitate international trade and investment. Second, Forex broker. A Forex broker is an intermediary between you and international currency market. They provide access to the interbank market and offer trading services to their clients. Forex brokers are typically registered with the regulatory agencies. They are required to meet strict financial requirements and provide clients with protection from fraud and other financial risks. Forex brokers provide access to the largest and most liquid financial market in the world. They offer a wide range of products including spot, forward, and derivatives, and use sophisticated trading platforms to facilitate trading. Third, speculator or trader. A speculator or a trader is an individual who buys and sells securities or other financial instruments with the goal of making profit from short-term price movements. Speculators take a higher risk than investors in order to potentially make a greater return. They typically use sophisticated trading strategies, leverage, and derivatives to maximize their profits. Speculators often rely on news and technical analysis to inform their decisions. 4. Liquidity providers. Liquidity providers are financial institutions that provide liquidity to the markets. They provide the capital needed for traders and investors to buy and sell securities or other financial instruments. Liquidity providers are typically large financial institutions such as banks, hedge funds, or other market makers. By providing liquidity, these institutions help to ensure that the markets remain orderly, efficient, and fair. They also help to reduce volatility, which can lead to better returns for investors and traders. 5th, leverage. Leverage in Forex is the ability to control a large amount of currency with a relatively small amount of capital. This allows traders to open positions with much larger size than their account balance would normally allow. Leverage is normally expressed as a ratio. For instance, a leverage of 50 to 1 means that a trader can open a position with 50 times the amount they have in their trading account. For instance, you have $10,000 in your balance. So if you use the leverage of 50 to 1, so how much you will be able to trade after the leverage? So the calculation is total margin, you have 10,000. So times to the leverage, which is 50. So the maximum you are able to trade $500,000. So it means that while you have $10,000 in your balance and using 50 to 1 leverage, so it makes you able to trade $500,000. And the $490,000 is provided by liquidity providers. So the leverage is the important instrument in the online trading, and most of the traders, they use leverage. The banks or financial institutions provide the leverage for traders and speculators. 6. Counterparty. A counterparty is any person or entity that takes the other side of an agreement. In Forex, the counterparty might be a bank, institution, broker, or retail trader. For instance, if a trader buys 100,000 worth of GBP USD, somebody else has to sell it to him, and that somebody is known as the counterparty. How the brokerage and online trading works. Online trading has formed from the following instrument as we have discussed earlier. 1. International currency market, which is the global exchange network. Second, liquidity providers, which is financial institutions, banks, hedge funds, or any other individuals. 3. Brokers, which act as an intermediary between a trader and international currency market. 4. Traders or speculators that buy or sell financial instruments in the market. So we already have studied all these important instruments. So the combination of them under a system has been called an online trading system or online market. So now how this system works. The trader places the order. After the trader placed the order buy or sell, the broker starts to execute the order. In this process, the broker looks for a counterparty, which means if there is any other trader in the system to take the other side of agreement to fulfill the order executions. If there wasn't any counterparty available at that moment among the traders, the broker automatically asks from liquidity providers to take a position against trader orders. Indeed, anytime we trade at the markets, liquidity providers or other traders take a position against us. If traders buy, they sell the required amount. If traders sell, they buy. So anytime trader lose the money, so the counterparty or liquidity provider mostly will gain. That is why most brokers act as a liquidity providers and counterparties as well, because they already know most traders, almost 80% of traders will lose, especially the newcomers. So at the same time, being a broker and counterparty or liquidity provider is not a good practice, because such type of brokerage system never intend that traders gain. The fake and fraudulent brokers don't have any liquidity providers. Only brokers themselves act instead of all. So investing with such type of broker is super risky. So that's why I have prepared a separate lesson how to choose the right brokers, which is in the next lesson. And I have explained in detail how to find the regulated and right broker. It is very important lesson. Don't forget to watch our next lesson. So not to miss the next lesson, subscribe to our channel and hit the bell now. Even if you are an expert trader but works with unregulated broker, you will lose everything sooner or later. Liquidity providers are always on standby for brokers' executions to provide the required trade amount. And also the liquidity providers provide the leverage for traders through the broker as well. If traders would like to use leverage or more than their capital, liquidity providers will facilitate that amount immediately. Liquidity providers are also connected to other financial institutions. Liquidity providers are also connected to other financial institutions and trade with each other, which is called interbank exchange. And the biggest and most exchange in the market happens through the interbank exchange system. The financial institution or liquidity providers are connected to the other international banks outside the country. So the combination of those international banks creates ICM or international currency market, which keep settling the price around the world. For instance, while you are connected to the Forex exchange from any geographical location, you will see the same price exchange and changes, because all the financial institutions, they are connected internationally with each other and they keep settling the international prices. So it is very simple. You already have understand how the brokerage and online trading system works around the world. So as a brief, let me explain you how the brokerage system works. Trader place the order, then broker execute the orders, and then liquidity providers provide leverage and liquidity to the market, and the last, ICM or international currency market settle the latest prices globally time to time. Thanks for watching our today lesson. Please don't forget subscribe to our channel now to watch our next lessons for free.